Hey, Steve Saretsky here. As always, it's the Vancouver real estate market update with a particular focus on Vancouver. If you get any sort of value or entertainment out of these videos, all I ask that you hit thumbs up and subscribe. Any questions, comments, put those below and we'll banter back and forth. I really want to discuss today in the Vancouver market sort of overall liquidity in the market, lending conditions, and really what this means for certain segments of the Vancouver real estate market, because this is really all tying together, all the pieces are starting to fall into place, and once you understand how the plumbing of the system works, you can really put the pieces together quite easily. So looking at, first of all, from a liquidity perspective, I mean, you don't get higher prices unless you have liquidity, i.e. Increased turnover of housing. So, you know, as a prime example, what we were seeing back in the heyday of Vancouver real estate was, this is probably the best example that I can find, was one house on the west side of Vancouver, detached house, basically all land value. The house was a tear down, it had basically zero value. This house was flipped 4 times in 3 years, and each time that the property resold, it basically resold at $1 million higher in value. So they basically, the buyer would come in, they would buy it, they'd hold it for 6 to 10 months, they would do 0 upgrades to the property, and then they would just flip it for $1 million profit, no problem. So basically what you can see is the land value is clearly going up basically by $1 million each year. And obviously when the market is highly liquid, when profits are to be made, you get increased speculation, and increased speculation begets higher prices. And it's the reverse on the way down. So you have a falling sales, an illiquid market, and that begets lower prices. And that's basically where we're at today. So if you look at overall home flipping activity, you can see that across all property types across Greater Vancouver, house flipping, which is a home that's bought and resold within 2 years, is at a 6-year low for the month of July. So we're at a 6-year low for house flipping. But if you look in the detached space, which is arguably the most illiquid market, you have home sales basically at a 30-year low. House flipping, from a monthly perspective, if you look at each month, July 2018 recorded the fewest homes being flipped in Greater Vancouver, even lower than November 2008, which is kind of the peak of the financial crisis when everyone thought the world was coming to an end, banks completely seized up, etc. Even today, we have fewer houses being flipped than that period of time, which to me is quite interesting because you still have to look at it from where are we today? The detached market, I mean, in Vancouver, we still have an economy at full employment. You still have everybody out there spending money, feeling good. And despite that, there's zero liquidity in the detached housing market. So, and that's partially why we have prices falling. If you look into the condo market, house flipping is down. It's down 43% from a year-over-year perspective, but it's still fairly elevated, but definitely trending towards less liquidity. Fewer homes being flipped. Obviously, condo sales are at a 6-year low there, so I expect that market to become more illiquid moving forward. But this creates a scenario where, okay, well, what is the market that's going to be, I would say, most impacted by tightening liquidity in the market? And it, without a doubt, is the pre-sale condo market. This is a highly speculative market that is predicated on prices rising, and it's predicated on the ability to flip contracts. A lot of these people that buy pre-sales were under the notion that you would just flip the contract prior to completion for a profit. So it didn't really matter the price that you paid. You put down your little bit of deposits, you flip it, and everything works, and it's worked tremendously. It's been a great trade over the last 8 to 10 years. But now you're entering a period where prices are declining, liquidity is drying up, lending is getting much tighter. So the ability to basically flip these contracts is going to trend to near impossible, I think, in the next 12 to 18 months. We look at this from a perspective of, okay, so if you can't flip it, like I'm already seeing contracts basically where these guys pay these extreme prices in 2016, and despite prices rising by 25% in 2017, they're actually still trying to flip these contracts today at a loss. Now, that's not every development. There's certainly many people that bought pre-sales in 2016 that have done very well, but there's certain projects where they've just paid way too much money, and the values, you're just selling at a loss. So there's one example. The guy bought in May 2016. He's now selling at a $100,000 loss, but he's trying to flip it. Now, what if he can't flip it even at a loss? If he cannot flip it, then he has to complete on the unit. So he's got to complete on the unit, but how is he going to come up with the funds to close on the project? What if he can't close on it? So the bank, if he needs a mortgage on the place, the bank is going to lend him the money predicated on what they appraised the unit at upon completion. They don't care what this guy paid as a pre-sale. I don't care if he paid 1.5. If they come in and appraise it at 1.3, they'll give you a loan based on the value being 1.3. So now you have a $200,000 shortfall to come up with. Well, how are you going to pay that $200,000? Because I can tell you from a lending perspective, there's no private lender that's going to lend you $200,000 when you have roughly 15% equity on a pre-sale condo. So basically what's going to happen is they're going to have to basically forfeit the deposits with the developer, and then the developer is going to sue them for the price of the shortfall. So the developer will basically take the unit back. They might have sold it to that guy at 1.5. They'll have to retest the open market, say they get 1.2. Now you have a $300K shortfall. They'll sue that guy in court for $300K. So not only has he lost his deposits, but he's lost his. He's going to lose in court too. So you can see how the pre-sale market is just absolutely loaded with risks in a down market. And again, like I said, it has worked tremendously well, but in a down market, it is not going to work. It's not a matter of if, it's just a matter of when this happens. And we're starting to see it very early cases right now from a liquidity perspective. And again, looking at lenders, this really brings us all back into where we are right now from a lending perspective, sort of tying this all in together. Look, like lending is getting tighter and tighter, the conditions. One thing that I would add on to this pre-sale space or pre-sale idea, you have to think that, okay, so as of today, we have a record number of condos under construction. You have a record number of condos housing starts. So this basically ensures that you have 2 to 3 years of record high housing under construction that basically is pre-sold, and there's a contractual obligation for these people to close regardless of what the price is when they go to close in 1 to 3 years. So all these people have these obligations, and the market is declining. We don't know if that market decline is going to continue, but if it does continue, which seems likely, how are they going to close on these units? Because the banks are going to come in and appraise them, and they're almost certainly going to appraise less than what you paid for. So I think it's loaded with it. And again, if you were to say, oh, well, I'll just flip the contract to someone else. Well, we're running out of buyers. As you can see that we're at 6-year low in condo sales. I can tell you that August numbers are going to come in, and they are going to be bad again. And this is going to continue as credit tightens, which we're going to get into now. Speaking with what's happening from a lending perspective is the banks are continuing to get tighter. We have loan originations down 18% in Vancouver in 2017. So you have a lot more people shifting into the private lending space due to stress tests, banks getting tighter, etc. And that all comes with the Bank of Canada and global liquidity just getting tighter, right? So that's happening. So people are moving into the private lending space. And so the private lenders now are getting like basically bank-worthy clients almost. Like people that are basically like normally would have got approved at RBC are now coming to the private lenders to get a loan. And so they're saying, wow, I've got this like pretty good quality borrower. I'm going to lend him some money. Why would I want to look at the guys that we used to lend to. The guys that we used to lend to would have been guys that 80%, 75% loan to value on a single family house, second mortgage. Well, that's what they're used to being lending on, and they're saying, well, why would I want to lend on that? This guy, why would I want to lend 75% loan to value on a detached house when that market is plummeting? When I've got a highly qualified borrower here that just got rejected from RBC, who otherwise would have been approved under old regulations. So the sort of the fringe borrower is just completely out of the market, and people that whether that's home builders, you're seeing it in the single family market particularly, where some of these guys have these high interest loans because they had an idea or a hope that they were going to be able to refinance after a 1-year bullet loan with RBC, and RBC is saying, no, I'm not going to refi you, and now they're just getting pushed further down the credit cycle, so to speak. So and just to give an example, you could see that with one it made headlines across Vancouver. It's like a shack in Vancouver that was basically bulldozed down. There's nothing left of the house, but it was like at $3.9 million or whatever. If you actually look and pull the titles on that guy, the guy had a interest-only loan at through private deal at 10%, and if he didn't pay back the payments back, the principal, by January 2018, the interest rate would jump from 10% to 24%, and of course, just by chance, the house happened to burn down in December. But you can see that this is going to be something to watch for, because there's the inability to roll loans in a tightening credit market, right? The private lenders are going after better quality borrowers, so everybody that's on a fringe is getting pushed to the sidelines, and this is just going to create more liquidity issues moving forward. And then again, if you want to tie the whole pieces together, you can look at what's happening even from in the Canadian bond market. I mean, we have these yields. I believe it was the 1030s that inverted last week. That hasn't happened in a long time. Basically, the yield spreads across all these bonds are basically flattening or close to inverting, which is generally a signal of oncoming recession. Generally within 24 months. It's not imminent. It can be much quicker than 24 months, but it's basically like that's kind of your time frame. So when you have guys like BlackRock and guys Jeffrey Schneider warning about these inverting Canadian yields, it's something to pay attention to. It's basically signaling what happens is with that is investors are essentially signaling that they are forecasting long-term growth. They don't like the outlook of long-term growth. They're basically driving down long-term yields as like a safety haven, and it also affects bank lending, which is really the most important thing. So you have to think about it like from a bank's profitability standpoint, is they're now borrowing money at like these short-term rates that are basically equivalent of the longer-term rates. So they're borrowing the money from the short term, and they're lending it out at rates no higher. So why would they even lend you money? They're not gonna make any money, because they're basically borrowing the money at the same cost they're lending it out to you at a longer term. So they're basically taking on added risk for less profitability. So this is just going to continue to clamp down on lending conditions. So you can talk about the stress test, you can talk about it might not be fair, etc. But at the end of the day, the bond market is going to speak, and if the banks don't like the profitability and the risk, they're not going to lend. So that's basically how it all ties together. Hopefully that helped. Hopefully didn't ramble on. I'm sure people will have questions, but again, feel free to put those below. And just as a caveat, right? I mean, again, this isn't to say that you shouldn't buy pre-sales or you shouldn't do this or that. I think it's just understanding the risks that are involved, understanding what is best for you, but just to understand that there are risks out there, and how these things tie together really matter on your purchasing decision, on your time horizon, etc. So, and again, I wanted to put this video primarily together on the pre-sale market because I get a tremendous amount of questions every week. I've done a lot of assignments. People, again, I think just people don't understand how pre-sales really work. They don't really understand the risks involved. People just think that, you know, they go in without representation and they just have no idea what they're buying. They think it's risk-free, but it is definitely not. But I think a growing trend to watch for is pre-sales. So recent government data for pre-sales is showing that new construction, which is basically pre-sales completing, made up 12% of all Metro Vancouver transactions in July. We only have the data for 2018 because it's only when the BC government started collecting the data. But you can certainly think that, okay, well, if it's 12% of transactions, that's pretty significant to the overall market. And I would expect that 12% to continue to grow as the resale market continues to slow and the pre-sale market still has a record high number of obligations that are going to need to be closed on. So I would expect that percentage of the overall sales to actually increase in the coming years. So hope that helped. Otherwise, see you next week.